We've got the new trading week underway. Let's check in on a money manager who says he's been cutting his exposure to Canadian stocks. Barry Schwartz, Chief Investment Officer and Portfolio Manager at Baskin Wealth Management. It is great to see you. So you've been moving into non-Canadian stocks. Partly you've been watching the currency, the Canadian currency. So explain that.
Well, the Canadian dollar has been very strong this year, right? I think it's up almost 5%. And I think it has more to do with just the U.S. Talking about cutting interest rates, whereas Canada, we're not quite sure. So money seems to fly to the home that has the highest interest rates and the best growth. Canada's really knocked it out of the park the first few months of the year, right? Much better economic data than the U.S. So I think that we've seen some strength in the Canadian dollar. And as a result, for us, it's made some U.S. stocks a little more attractive, obviously, to buy. You're going to buy them at 4 or 5% cheaper. Hopefully, the Canadian dollar doesn't go 5% higher from here, obviously, but that's attracted us.
And the old complaint, you just can't build a decently diversified portfolio if you stick to Canada.
You're absolutely right. I was looking this morning, Andy, at Tech Resources. If you look at the stock today, $29. It's trading below the price it was trading at in 2005.
Are you serious? Maybe we could put up a 20-year chart.
Suncor, CNQ, all these stocks haven't done anything since the mid-2000s. And so if you're looking like we are as long-term investors and looking to compound the wealth for our clients, we can't do it with these commodity companies.
That's ugly, isn't it?
It's terrible. So these type of companies are more trading vehicles. Look at Barrick Gold, for example. People are cheering that gold's at a 6 or 7 year high. Well, that means you haven't made any money for 6 or 7 years owning gold stocks. So I'm not smart enough to know when a commodity cycle picks up again and when to sell out and when to get back in. I'd rather just own good quality companies that are compounding wealth. And so when I look inside Canada, sure, there's a number of wonderful companies. But when you look at the U.S., there's 10 times the amount of companies. So the areas to fish in, there's so much more fish.
Some of the names, you like luxury goods, you like travel. Disney, why do you favor Disney these days, Barry?
Yeah. Well, we looked dumb owning Disney for a few years. We started buying Disney in 2015.
All the worries over ESPN.
And the stock did nothing, even though the company was absolutely compounding cash. The earnings were growing. But, you know, I guess they pulled one out of the hat with the streaming business. No question they own one of the best businesses in the world, which is the parks. I heard 1 million people have already rode this Millennium Falcon attraction at Disney, and they're opening more Star Wars stuff there. So what we like, Andy, is the growing trend of emerging market wealth. People outside North America are getting wealthy. They're getting wealthy fast. They're going to want to travel. They're going to want to spend money on luxury goods, high-end alcohol, you name it, and we want to get exposure. We're not necessarily saying we want to invest in emerging markets, but we want to participate in emerging market wealth.
The only big park that I've ever brought my kids to was the Asterix park outside Paris, because my daughter was an Asterix fanatic. I've never taken them to a Disney park.
I've been there, done that. Maybe one day I'll go as a grandfather, but I hope to God I never have to go to any of those parks again.
No, because they certainly get revenue out of you, I've heard, at every opportunity. You're buying airlines lately, or you have been lately.
We have been, and one of our largest holdings is Delta Airlines. And my thesis is two-pronged. First, the number of airlines has shrunk dramatically in the U.S. There's now only 4 large carriers. So I feel that the competition has really been kicked to the curb, whereas Delta benefits, of course. They don't have that Boeing 737 MAX, so they're absolutely benefiting.
Southwest would be more exposed there.
You got it. So people are scared to fly those planes. A lot of businesses translated Delta. But what we're most excited about is the credit card business. They've signed a deal with American Express. Essentially, those loyalty miles from American Express are used to buy Delta seats on the plane, and those purchases are done with huge margins. Essentially, we see a huge free cash flow coming over the next 3 to 5 years from American Express customers buying Delta points. And at the end of the day, this is not priced into the stock. We see about $5 billion of free cash flow from Delta in the next few years. And the stock is trading, I think, at a market cap of about $35 billion. So this is too cheap in our opinion. And we think a few years ago, the railroad stocks were misunderstood and traded at 10 to 13 times earnings. And all of a sudden, people recognize that these companies have great pricing power. We see the same thing happening with the airlines in the next couple of years.
Now, Amazon, we're expecting their numbers later this week. Thursday is the latest I've seen. You've been a buyer or at least a holder of Amazon.
We were late to buying Amazon. Essentially, we bought it 5 minutes ago, but we bought Amazon when everybody was worried a few weeks ago about the antitrust regulations in the U.S., and Amazon fell to about $1,700. So I think we got into a good price. But this is, for us, a long-term hold. I don't know if you saw Microsoft's earnings, but the cloud business is growing by leaps and bounds. The margins are expanding, and so many companies are moving to the cloud. Our big Canadian banks haven't even moved their technology to the banks.
To the cloud.
To the cloud.
Yeah.
So the opportunity in the cloud is multifold. It's many years to go. It's also potential in emerging markets. So that's just one reason why we like Amazon. But there's so many addressable markets that Amazon is getting into. As we see, they're beating up the competition. And so even though the valuation is kind of high for us, we feel that this is a good time to get into a company with huge tailwinds.
You think, if you look at interest rates and they're low level, particularly in America, or going lower potentially, you think stocks are cheap?
What is going on with Europe? Interest rates are negative. I assume this is an experiment to try and kickstart the economy, to try to incentivize banks and businesses to lend money, to borrow, consumers to buy stocks, to invest. And interest rates aren't quite negative yet in North America, but after paying someone a fee and taxes and inflation, your returns are negative buying fixed income, safe here. So we feel the same thing eventually is going to happen. No question the stock market valuations are higher than the long-term average here, but we've never experienced low interest rates like we have today. And of course, the central banks telling us that they're standing at the ready to cut interest rates, and most commentators feeling that interest rates are going to stay low for years. So if you're buying stocks and you feel that you can get organic growth and dividend growth, company has competitive advantages, then I think you should be willing to pay above average prices, especially if you think you're going to earn not very much from safe investments.
Just finally, you've always been a skeptic on the cannabis stocks. Give us your thought. Maybe you could put up with the 1 year for HMMJ again as a benchmark. Can trust, obviously, a black mark for the industry.
Well, I mean, these things are going to happen in an industry that's in its infancy, and so this is to be expected. Obviously, it is. You want to get this right, and certainly with CanTrust, where they were focusing more on the medical side, this is clearly negative. But I think what we're going to see is a transition from these companies hyper growth to really quality management, quality oversight. But at the end of the day, Andy, these are not companies that I think retail investors should be investing in. They're way too speculative, and I don't think over the long term anybody's going to earn quality returns.
And the huge valuations still.
The valuations don't make sense. It's completely speculative. You're in the venture capital industry when you're lending these companies money.
Thanks, Barry.
Thank you very much.
Barry Schwartz kicking off the week for us. He's Chief Investment Officer, Portfolio Manager at Baskin Wealth Management.